Hey everyone, welcome back to my channel Beers and Bulls. This is Ranjit. If you're looking to navigate the often turbulent waters of financial markets, then you have come to the right place. Today, we are diving deep into one of the most fundamental yet powerful tools in the traders and investors' arsenal. Yes, you have guessed it right, it is moving averages. Whether you are a complete beginner just starting your career, an active trader looking for an edge, a long term investor seeking better entry and exit points, understanding moving average is absolutely crucial. By the end of this video, you will not only know what they are, but also how to use them and make more informed decisions. So hit that like button and subscribe if you haven't already, and let's get started. What exactly is a moving average? Let's start with the basics. Imagine you are looking at a stock price that's jumping up and down erratically. It can be tough to see the true trend, right? That's where moving average comes. In its simplest form, a moving average is just the average of securities price over a specific period. It smooths out price data by creating a constantly updated average price. Think of it like taking a lot of choppy data and drawing a nice, clear line through it to show you the general direction. As each new day's price comes in, the oldest price point is dropped, and the newest one is added to the calculation. This moves the average, hence the name moving average. Its primary purpose is to help us identify and confirm trends. While there are several variations, the two most commonly used and important types of moving average are the simple moving average and the exponential moving average, also known as SMA and EMA. The simple moving average is exactly what it sounds like. It calculates the average of prices over a set period, giving equal weight to each price within that period. Think of it like this. If you are calculating your average test score over 5 tests, each test score counts equally. That's the SMA. It's straightforward and provides a very smooth line, excellent for identifying long-term trends. Now, the exponential moving average, also known as EMA. It is a bit different. While it also smooths out price data, it gives more weight to recent price action. This means it reacts more quickly to new information. This is the most fundamental use. When the price is consistently above a moving average, it suggests a uptrend. Conversely, when the price is consistently below, it indicates a downtrend. A flat moving average often suggests sideways or consolidating market. Moving averages often act as dynamic support and resistance levels. In an uptrend, a moving average can act as a support level where prices tend to bounce off it and continue higher. In a downtrend, it can act as a resistance level where prices struggle to break above it. Golden cross. This occurs when a short-term moving average like a 50 MA crosses above a long-term moving average like a 200-day moving average. It's generally considered a bullish signal suggesting a potential long-term uptrend. Death cross. Conversely, a death cross happens when a short-term moving average crosses below a long-term moving average. This typically is a bearish signal indicating a potential long-term downtrend. While these are powerful, remember they are lagging indicators. They confirm a trend change after it's already started, but they provide valuable information. Investors often use these for major trend shifts, while traders might use short period crossovers for more frequent signals. The relationship between price and the moving average can also indicate momentum. When price moves sharply away from a moving average, it suggests a strong momentum. When they consolidate closer to a moving average, it can indicate a slowing of a momentum or a potential reversal. Traders might use this to gauge when a move is becoming overextended and due for a pullback or consolidation. The ideal period for a moving average depends on your trading style and the time frame you are analyzing. Common ones include 9, 21, 50, 100 and 200 people. Experiment to find out what works for you. Remember, moving averages are based on past price data. They are lagging indicators, meaning they confirm trends rather than predicting them. Don't rely on them in isolation. The real power comes from combining moving averages with other technical analysis tools like candlestick patterns, volume, or other indicators like RSI, MACD, etc. to confirm signals. This reduces false signals. Moving averages aren't foolproof. Markets can be unpredictable, and false signals do occur. Always use proper risk management. The best way to understand moving averages is to apply them. Open up your charting platform, add some moving averages, and see how they interact with different stocks and different time frames. And there you have it, your comprehensive guide to moving averages. From understanding what they are to leveraging their powers for trend identification, support and resistances, and powerful crossover signals, you are now equipped with a fundamental tool for navigating the market. What's your favorite moving average period to use? Let me know in the comments below. If you found this video helpful, please give it a big thumbs up, share it with your fellow traders and investors, and subscribe for more valuable content like this.